5 years of non-stop losses. Valuations cut in half, and then cut in half again. For half a decade, the global consensus has been completely unified. China's real estate market is dead. But then, out of nowhere, the data spiked. In a single day, 1,632 second-hand homes were sold in Shanghai, and it wasn't an isolated anomaly. Property registrations in Beijing just hit a 15-month high. The data shifted so abruptly that analysts at JPMorgan Chase issued a formal report labeling this exact moment a tipping point. If those institutions are right, the market is currently pivoting toward a recovery that would take years to replicate. But rushing in blindly to catch any stock on the way down is how investors end up holding a falling knife. Surviving this reshuffle depends on separating temporary dead cat bounces from a true systemic market bottom. Let's look at the mechanics behind the data to find out which one this is. To understand why this is happening now, you have to look at how the Chinese government manages economic cycles. They follow a clear 4-stage pattern: reap, dead, release, and chaotic. Over the past 3 years, they squeezed the market to eliminate excess, the reap and dead phases. Right now, we have officially entered the release phase. This began with broad policy adjustments. The government lowered down payment requirements, initiated tax refunds, and relaxed the restrictions on who could legally buy a home. But they quickly escalated to direct financial injections. As of early 2026, the government approved more than 1.4 trillion yuan in whitelist loans. This is roughly 200 billion US dollars acting as a direct lifeblood transfusion, poured straight into millions of stalled housing projects across the country. They are also executing a much more aggressive secondary step, directly acquiring unsold existing housing stock and converting it into affordable housing. Look at this chart tracking unsold commercial housing. For 52 months, inventory only went up, but in spring 2026, that area finally shrank. Think of a warehouse bursting with fresh bread. For 4 years, deliveries outpaced sales. Now, the backlog is depleting. This is what separates the current momentum from the false starts of the past few years. It is backed by aggressive, real money government intervention, creating a tangible inflection point in the data. A broad market rebound doesn't save every company. If you pull up a stock screener and buy whichever property company has fallen the furthest, you are likely walking into a financial mass grave. The trap lies in the highly indebted private developers like Evergrande or Sunac. The sheer scale of their liabilities means that even in a broad industry bull market, their individual debt holes are simply too deep to escape. You might see headlines about them passing debt restructuring plans, but that is largely an illusion. It is the equivalent of a hiker trying to climb a steep mountain while carrying hundreds of pounds of rocks. One slight misstep, and the weight pulls them back into the abyss. To protect your capital from these traps, you need a disciplined approach. We evaluate these assets using a proprietary system called the 3-stage framework for 10-bagger stocks. The critical window of opportunity is identifying companies transitioning from phase 1 to phase 2. In phase 1, a stock is severely undervalued because the broader market is panicking. In phase 2, the company's profitability and business model begin to be formally recognized by the market again. If you want to learn how to apply this framework systematically and build a long-term portfolio without constantly stressing over market volatility, check out our free SFA Stock Investment Masterclass. The link is right below this video in the description. Speculating on dead companies will inevitably wipe out your account. Following a 3-stage framework allows you to filter for quality, capturing the market upside while keeping your risk under control. So who actually survives this reshuffle? The future winners of this wealth transfer are the financially sound, state-owned industry leaders. Because their roots are deep and their financing costs are extremely low, they possess a distinct operational advantage. While their highly leveraged competitors collapse, these state-owned leaders are quietly absorbing the leftover market share and acquiring premium land at severe discounts. Many analysts point to Japan's lost 30 years as proof that China's real estate will stagnate indefinitely, but that comparison misses the core mechanics. Japan's bubble burst when their urbanization rate was already maxed out. China is still actively urbanizing, and their government holds far more direct financial resources to intervene than Japan ever did. When timing your entry, you must remember that stock prices consistently lead the real economy by 3 to 6 months. By the time mainstream news declares the housing market fully recovered, the stock prices will have already surged. The optimal time to buy is exactly when the market still feels pessimistic. As legendary investor John Templeton taught, the best buying opportunities emerge at the point of maximum pessimism. Right now, based on the price to income ratio, housing in China is at its most affordable level in 10 years. That is a textbook signal of a market bottom. Even with all these positive signals, strict risk management is mandatory. Do not put all your money in at once. Build your positions gradually in batches, and strictly limit your exposure in this specific sector to no more than 10 to 15% of your overall portfolio. Real investing is not about predicting tomorrow's slight price fluctuation. It is about identifying deeply undervalued assets during a panic and accumulating them while everyone else is looking away. If you found this breakdown helpful, hit the like button, subscribe, and use the link in the description to access the SFA Masterclass. I'll see you in